Good afternoon. It's April 29, Friday, and welcome to episode 42, Palpable Fear. Good afternoon to you, Wowie.
Good afternoon, Mark.
And good afternoon to our loyal listeners. I hope everyone is fine and everyone had a good week so far. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wowie Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wowie are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. For those who have missed it, episode 41 previously that we recorded last week was entitled Turbulent Times. Me and Wawi discussed the stock market, the weekly sentiments, which we're going to go into briefly, the bull, the bear, the fund flows, and also we discussed the potential possibility of 50, if not even 75 basis points on the next Fed rate meeting. And also we briefed through Netflix wild ride resulting into a $400 million loss to one of Wall Street greats investor, which is Bill Ackman and his Pershing Square fund. So for this week, we're going to jump on to our weekly sentiments and so much more. So we're going to start off with this screenshot right here. Stocks tank as Amazon endures worst day since 2006. So everybody's feeling the heat at this point in time. What do you think about this, Wowie? It's a sell-off, looks like.
Yes, it's definitely a sell-off. And much lower this Friday.
Mm-hmm.
Yeah, it went much lower this Friday, including Amazon dropping down like 14-something%.
Yep, 14 near at lowest. It was more than even 15%. So another screenshot from Financial Times. It's the Nasdaq index marks worst monthly drop since 2008 financial crisis. So this is a Nasdaq index which is tech heavy. The big the FANG stocks, which everybody knows, Facebook, Alphabet, Netflix, and Amazon. Now, Alphabet is also known as Google. So now we're gonna jump on to the sentiments, which is weekly. We follow on in this podcast. So this is American Association of Individuals Investors. We are seeing a very bearish sentiment at this point in time. Bears are now at 59.4%, almost 30% more than its historical average, greater than the past month, whereas bulls are lowered down to 16.4%. So the more bearish the sentiment, the more people are thinking that the market will go down, at least in the survey, for the next 6 months. Next is the put-call ratio, which is the options market, otherwise known in this podcast as the tail that wags the dog. So a lot of people are ramping up their put options buying, meaning that they fear or they're actually guarding themselves against a market downturn. At times, this could serve as a contraindicatory sign, or the one that would usually mark the bottom. But as we look at this chart, yep, it looks like it's even higher than where it was back in December. For the volatility index, this kind of like measures the up and down motion of the S&P 500. The more it goes up, the wilder the market goes down. So for the past 5 days, it's up 15%, which clearly reflects the downtrend in the S&P 500. The current VIX or volatility is at 33.4. The VXN or the Nasdaq volatility, this measures the tech ride, the tech crazy ride, as I would say. It's only up, believe it or not, 4.28% the past week, even though that the Nasdaq, as we're going to see in a little bit, has been clobbered this week so far in the past 5 days at least. The fear and greed index, we're currently at fear. We're at 28. We're way down compared to last week at 41. Market momentum, meanwhile, reflects extreme fear. So a lot of sell-off happening in the stock market. Market momentum It's a quantitative measure that we're gonna include moving forward in this podcast. So it just shows what the sentiment is, and clearly, it's not only isolated. The fear aspect of the market at this point in time is not only isolated in one survey, but it's also in other quantitative measures such as market momentum. Put and call options, as we have already discussed, it's been highest since January of this year. So for the past 5 days, we're seeing Nasdaq as the biggest underperformer compared to the three other major indices, which is the S&P 500 and the Dow Jones. Nasdaq down 3.8%, S&P 3.4, Dow Jones Industrial 2.6% down. Since the start of the year, Nasdaq is in the bear market. It's down 20.78%, followed by S&P 500 is down 12.9%. Dow Jones Index is down negative 9.2%. So for the flows, fund flows, this is published just this morning, fresh from the oven. This is from Reuters. They say U.S. equity funds post a third weekly outflow. So recalling from our previous week, we have seen a large outflow from stocks last week. So it does look like it's been ongoing. So investors have been pulling out of stock market funds. At least for this week, 10.55 billion have been pulled out, at least 34% lower than last week, but still an outflow coming out of US stock market. The large cap funds drew their weekly inflow in 3 weeks. Interestingly, so despite the big outflow, it has slowed down. Large cap has experienced some inflow of 698 million, a little more than $500 million. Small cap, meanwhile, still experienced a huge outflow. Mid to small caps. So mid caps experience almost 1.7 billion outflow, while small caps experience 1.74 billion in outflows. Non-stop selling while we in the small cap and mid cap companies.
Oh, say that again, Mark. I was busy sneezing.
So I was just saying, so there are three kind of capitals, brackets in stock funds. One is large cap, mid cap, and then the small cap. So large cap experienced some inflow, more than $500 million, while small and mid cap experienced continuous outflows, almost at 1.7 billion apiece. So looks like small caps aren't feeling the love.
Oh, okay.
Mhm.
Well, I don't know much to say about it. Most of my investments are on mid cap and large caps. I haven't been keeping track of the inflows and outflows on those market caps. So
probably,
I'm sorry.
yeah, in my opinion, probably it's just indicating that the investors are now at least slightly turning a little bit softer and heartfelt on large caps compared to the small caps, which have yet to prove their long-term profitability. That's my thought. Maybe
Oh yeah,
that's why some fund flow is going in to the large cap. Regardless.
absolutely.
Mhm,
Yeah, absolutely. You should look at small caps as higher risk
mhm,
because you know, they're just most of them are just starting out, right? Or
right. They still
yeah.
have built that reputation.
Mm. But that's those larger risk companies. If you can find one that has a huge potential, then go for it. But
Right.
you really have to, they're gonna be hard to find. But if you
Mhm.
find one, that would be wonderful.
Yes. You
And
have
the
to dig
best
in
way
the
to,
papers. Mhm.
yeah, you have to look at the financial statements for sure. That's where you will find them.
Yep.
Um,
Yep.
I think that's what made Warren Buffett so good is he would read through thousands of papers. Back in the day, they
Mhm.
have books instead of like what we have right now, which is
Yes.
everything is online and readily accessed.
Yes.
But But Warren Buffett was well known to like read uh, books of thousands of pages, including Japan's trade books,
Mhm.
and he would just read through it. So he's very analytical when it comes to that.
Right. And now we have softwares and stuff, which we're gonna look into closer in the coming minutes, because we're gonna dissect the big tech earnings at least. Also for in concern with the fund flows, money market drew 43 billion in biggest weekly net buying. So people are putting some money in money market funds, pulling them out from the stock market, putting in the money market as a serve as a cash cushion. So people are definitely getting more defensive nowadays. Even bond funds saw an outflow of $4.53 billion. So,
Well, you can call me crazy
mhm,
or a contrarian, but
mhm,
I'm doing the opposite. I am almost used up 75% of my dry powder
mhm,
at this early in the game. So I think I'll just reserve my remaining 25% dry powder for further changes coming along.
yep.
But when there's a recession like this is when you have to look into like your deepest conviction stocks or companies
Mhm,
that are considered investment.
right.
Remember, you have to like determine what's a good business and what's a good investment.
Mhm,
So once you find a good investment and you have set your conviction, then when it comes to these points, you don't run away. You keep investing in them. And
right.
I think and this is not an investment advice. I think I've studied enough, and
Mhm,
maybe it's not very thorough. But I reinvested more into Tesla and Amazon.
mhm,
But that's where my some of my convictions lie. And I have other smaller companies that I invested in, but I think these two companies have a great runway moving forward. So, and
right.
just I'm just throwing it out there.
So you
Once
do,
you
uh-huh. So you do
once
think
you've
you, oh, go ahead.
yeah, once you've set up your mind after doing your homework, then um, you go for it. Don't be
Mm.
scared.
So you do think we're kind of in a recession at this point in time?
Well, you got me convinced. Um, for one, I was thinking, because I was also looking at Urian Timmer's analysis,
Mhm,
looking and comparing what's going on a few months ago, last quarter, like this is World War II,
mhm,
um, and what we did back then, and the trend. And he thought we were at mid-cycle. So that's why I did the poll during our in our messenger group
mhm,
to see what people like you are thinking.
mhm.
And when you and one other member in our group said that we're in a recession, and the other member said we are in an early cycle, I said, wow. So I am behind, because I was still thinking we were in somewhat like the late cycle of
Mhm.
the market. So I was still not in the recession mode. So when I heard from you that we're already in the recession mode, I'm already going for it. I'm already
Yeah.
going for.
The thing is, like, we've been, you know, during our past podcast for, since this start of the year, we've been monitoring the consumer sentiment even going lower and lower, which we're gonna
Yes,
see in a little bit. There's a sudden
yes.
surprise of uptick at least last month. And
Mhm.
the government just reported the first quarter GDP, and we actually recorded a negative 1.4%. So that's a
Yes, yes, it did.
contraction.
Yes.
That's not a good sign, meaning that the economy is not actually growing faster than expected. But a little
Yes.
bit
No,
of
it's not.
mhm. but a little bit of leeway, because 2021 compared to last year, we were just reopening. So we may have registered a little bit more GDP growth last year. And now we're just going back into a kind of like a lower pace, but still steady growth. Um, but there's no telling. NBER, or National Bureau of Economic Research, identifies a recession after two consecutive quarters of negative growth GDP. So we already locked in one as of this time. So that's quite a number to
But
see.
but this is definitely a sure sign that the U.S. economy, the U.S. market economy, is really part of a larger global economy. What happens in China and what happened in Europe, for starting out as a small portion of what's happening right now is growing into a larger influence in the downtrend in the economy. We know that we are highly dependent on these other countries for our own economy's growth. So there's the synergy, if you can call that's necessary for the U.S. economy to move forward, is for China to start producing again, and for the U.S. market to start buying the products over there, and then vice versa. But that's just looking at the China-U.S. relationship right there when it comes to trade. But then later on, we will realize that the global market economy is growing all around the US. And then we have to trade with those other countries for our markets to keep growing.
Yeah, it's everybody's interconnected.
Now it is.
Mhm.
Definitely, now it is.
So we're going to take a closer look at some specific stocks at this point in time. Just looking at their performance since the start of the year. Best performing in this group are, of course, the big oil companies. ExxonMobil, it's up 34.17%. Chevron at 31.37% since the start of the year. Berkshire Hathaway, which is the value of value stocks, up 7.3%. Apple, meanwhile, is down 13.38%. This is one of the big techs, FANG stocks. Wells Fargo, a reopening play, supposedly a better play for higher interest rates. It's down 14% since the start of the year. Microsoft is down 17%. Everybody else is down from this point. Alibaba is down 19.35%. Well, there's a big difference there. Alibaba has been, in the bear market since last year, never recovered from it. Google is down. It has entered the bear market. It's down 21%. JP Morgan is down 26%. Amazon, including today's 15% drop, is down 27%. It's even more than the bear market. Facebook is down 40.70%. Robinhood, one of the high-flying stocks back then, has nearly lost half of its value at 46.8% since the start of the year. ARK Investments, Kathy Wood's fund, is down more than half since the start of the year, 51.41%. Teladoc, which is one of Kathy Wood's bids, it's down 65% since the start of the year. And Netflix, worst performer on this bunch, is down 68%. So no mercy, whether it's big tech, small tech, big bank. I mean, it's only oil and Berkshire. Warren Buffett's Berkshire in this group is positive.
Yes. Yeah, although Berkshire Hathaway's one of its largest holding is Apple, it's a very diversified company. So it's another good, if you want to diversify, you have the S&P 500 index, and I think another diversified fund or company would be Berkshire Hathaway.
I think Berkshire definitely it will be a good kind of like anti-growth, or not even anti-growth. That's too contrarian to say, but obviously it invests in growth, but it's more of value because it doesn't pick like high flying profitless companies. It chooses the best companies around. So we're gonna go into.
So if you want value, you get a blend. If you have the S&P 500 index and Berkshire Hathaway in your investment.
Yep. And just buy on an average like monthly basis. That way, regardless what the market does over time, it goes up. So you just average down if the market just keeps going down, and you'll reap the benefits later on.
You may have given me an idea to do it with my other 25%.
Well, we'll see how it goes. Tomorrow's Berkshire's annual
Mhm.
meeting, so well,
Mhm.
let's stay put. Let's see what Warren Buffett and Charlie Munger says about the ongoing economic situation. Now that we know that the U.S. just contracted for the first time since the COVID lockdown last quarter.
Mhm.
For the miscellaneous, we're looking at some screenshots of the big tech companies. And shortly, we're going to dive into its numbers. We're going to probably follow a brief kind of like summary of how they performed on the last 3 months. So, according to this screenshot from Bloomberg, it says Amazon's COVID era build out proves too much as demand cools. Overcapacity, inflation, and supply issues drive costs higher. So if we're going to look at the Amazon's numbers right now, this is from Seeking Alpha. So Amazon is currently at $2,485 a share. It's down 14% today. It's close to its 1 year low at $2,432 a share. It's currently valued at $1.42 trillion. Amazon is a $1.42 trillion company. If we're going to take a look at its performance, it says here that they met Wall Street's revenue expectations, but they miss earnings estimate. So Wall Street was expecting a profit. Amazon delivered a loss. So if we're going to take a look at their report right here, PDF file, hopefully their numbers. There we go. So Amazon actually lost some sales. So their online Amazon Prime business, they lost a good amount from 57.49 billion last year. It's down to 56.45 billion, which is about 1 billion in difference. Meanwhile, their services, which includes the Amazon Web Services, it grew nearly $9 billion. So that's what saved them, at least, the Amazon Web Services. And of course, their fast growing advertisement business. So nonetheless, they delivered $116 billion in sales compared to 108.5 billion last year. Their profit, meanwhile, they delivered a loss. So we're going to look at the loss. They delivered 844 billion in losses compared to profits of 8.1 billion last year. I think they also reported a good loss on their ongoing investment in Rivian, which offset a lot of their profits at this point in time.
Yes. So their investment on Rivian is one of the factor, but Amazon is not alone in this, loss. Most of their loss looks like it's from fulfillment services. With the shortage, of supply and the traffic at the LA port, where they were forced to get their own ships,
right,
and their own trucks to distribute their goods to their warehouses. That's been a big part of this first quarter loss.
Yeah, shipping costs have risen, and that's why they also increased their Prime membership as well.
So I don't know if their CapEx has increased as well now that they're acquiring their ships, their airplanes this time around. I think they're issuing a lower guidance for next quarter as well.
Yeah, for operating profit for next quarter, they projected negative $1 billion to $3 billion, compared to Wall Street estimates of around 6 or 7 billion. So definitely they didn't meet expectations on that aspect as well, and their outlook. That's why Wall Street has sold on its stock. So that's what we have seen today. It's down quite huge from somewhere around how much? 3,200 in the morning, and it's down to 2,400. So, but yeah, speaking of CapEx, capital expenditures, they have spent in the last 12 months at least $64 billion in capital expenditures compared to 45.4 billion the previous year. So that's a good jump. Yeah, and their Rivian loss investment is around 8.9 billion or 8.5 billion. So that offsets their operating profit of $3.67 billion. So I think it's the combination of the outlook and the losses that they didn't meet. So if we're gonna look at their net sales, still looking at some prime dealings. So North America Prime, you're right, Wowie. They actually registered 1.57 billion loss in Amazon Prime here in the US. Internationally, they also experienced 1.28 billion loss. Whereas it's AWS, web services, it's up 6.5 billion compared to 4.16 billion last year. So that saved them. I'm wondering
That's
how
their
much
main market.
advertisement. Yeah. Cash standing is pretty good. They have about 30 plus 36 and a half. So 66 billion in cash, while they have about 47.5 billion in debt. Plus long-term lease liability is 65. So they're quite leveraged at this point in time. So that's Amazon for you. Now we're gonna take a look at who's next on the screenshot. Apple. So Apple expects supply shortages to slash by up to 8 billion. So the range is 4 to 8 billion revenue that's gonna be taken out of Apple's business in the coming 3 months. It says here, according to Bloomberg, new COVID-19 lockdowns in China are disrupting the supply chain. Apple's outlook or dour outlook follows record sales for a non-holiday quarter. So if we're going to look at Apple right now, oh, this is Alphabet. Where's Apple? I don't think we have Apple pulled up. All right, we're going to get you back. We're going to get back to Apple shortly. So next thing is growth stock sell-off tends to. Here's another screenshot for. Or do you want us to go to Apple's earnings right now, Huawei?
Yeah, we have a lot of Apple investors in our group, so I think we'll be doing them a favor if you pull it up.
Yeah, I think it's better too. I'm not sure why I didn't have it handy at this point in time. But they did meet expectation yesterday when they came out with an earnings release after hours. Actually, Dan Ives was being interviewed as they released, and their stock was up 4% to begin with.
Yep.
And then after that, they dropped like 4% afterwards. It primarily happened because some of the conversations that had just happened during the earnings call at that point in time when Tim Cook was on the phone and being interviewed by Wall Street bankers. So now we're pulling up Apple's investor updates. So we are seeing how we actually review one company here.
I think how they're pricing the companies right now is not just based on earnings, but on future earning guidance.
Right, forward earnings, it's earnings potential. That's true. Forward profitability and stuff. The weaker the outlook is, the worse outlook it would be. The worse performance it would be. So Apple currently is down 3.6%. It's at $157 a share. It's still mid-range for the past year performance. It's mid-range between 122 and 182. So it's not at 1 year lows at this point in time, despite the sell-off. Its price to earnings ratio is 27 times. Its market cap is $2.56 trillion. So if I'm going to take a look at Amazon's forward earnings is 60 times. So Apple is obviously a little cheaper. I'm not recommending a buy right there, but it says here, Apple Pops. See, their initial publication was Apple Pops, like the stock popped up after it beating expectations, but it actually wiped wiped out its gains and ended up in losses today. So if we're gonna look at their
Would,
press
would
release,
it still be good to look at its PEG ratio
yeah, peg
in,
ratio, the lower the
of
better.
Apple?
Yeah, it's a good indicator as well. That's what Peter Lynch also takes a look at. Apple reports second quarter, their revenue, their sales is up 9%. So if we could see their numbers right now, we just have to pull it up. All these links lead to another PDF file. So for the quarter that just ended in March, their sales is up to $97.27 billion, up from $89.5 billion last year. So their products, incredibly, people are still buying iPhone, nearly 5 billion more compared to last year. Their services is up nearly $3 billion compared to last year. Their margin, well, let's just look at the bottom line. Apple grew its bottom line by about 25 billion minus 23. So about $1.4 billion more this year. So they actually beat Wall Street expectations according to the Seeking Alpha results publication. But let's see what happened there, why their stock is down. Well, I don't know why, but interesting, it must be the market sentiment regardless. So if
I
we're gonna,
think so. Yeah, I
yeah,
agree.
if you're gonna
I was
take a,
able to
Mhm.
I was able to pull up their PEG ratio for 5 year. It's 2.68. What do you think about that?
I think it's still pretty much a little elevated compared.
Yeah.
Does it say their industry? If it shows their industry,
Yeah, it's 2.58 for the industry.
yeah, I think it's still elevated in terms of that. But yeah, going to their product section, iPhone sales, it's up nearly 3 billion.
Nice.
Mac sales, MacBook stuff, it's up nearly 1.3 billion. iPad sales are down $200 million. Wearables, home and accessories like the Apple Watch and the AirPods, it's up $1 billion. Services, it's up a huge amount. It's nearly 3 billion or 2.9 billion more, the services. So,
Well,
mhm,
and you have to think they're just now reopening some of their stores.
right.
So,
Yeah,
right?
and this company has ever been growing their cash cushions. So at this quarter ended in March 26, company has $141.2 billion in marketable securities, which is considered as cash, plus 28 billion and 23 billion more. If we're gonna add all that together, roughly we would end up at $192 billion in cash. And
Woo!
they just announced that they're gonna buy back some more stock amounting to $90 billion. This stock is not going down. I mean, $90 billion in buyback shares. This would ultimately support as a base or as a support for its share price to not tank during a recession. Or so as we believe. Anything can still happen with Wall Street. So that's Apple for you. So next we're gonna look at a screenshot here. So that makes me interested before we jump on to the next, by the way. So Apple delivered how much profit again for this quarter? 25 billion. So if we're gonna, and Amazon meanwhile delivered how much losses? 3 billion, right? 3.8 billion. Um, despite generating 69 billion in sales. So it appears that Apple is definitely a profit making machine compared to Amazon. Growth stocks sell off according to Financial Times. So Twitter, oh, what happened? Okay, there we go. Twitter is down 9.7%. We're gonna look at the biggest loser. Of course, Netflix. Netflix is down almost 69% since its peak. Sorry about this technical issues. We're going scrolling up and down. Facebook is down 39%. Oh, this is since the start of the year. So we already taken a look at this. Sorry about that. So next screenshot is Kathy Wood. Kathy Wood's performance, ARC Innovations, down from 100, nearly 160 a share down to $50. So a big loss right there since its all-time high back last year. But if you're an investor pre-COVID or during COVID, I think you're still in the green at least.
It's just like a lesson of taking profits, you know, when you have a chance. But I think we're just wired not to do that because we're expecting more all the time.
There are definitely biases thinking that the market will, forever go up or down. But currently, we're experiencing, a huge lesson to pay with our hard-earned money, experiencing a correction phase, and now Nasdaq actually is in the bear market. So ARC Innovations. So looking at its top 15 portfolio, number 1 is Tesla, followed by Zoom Video, Roku, Coinbase, Block, aka Square, Exact Sciences, Unity, Teladoc, Twilio, UiPath, CRISPR, Intelia, Spotify, Shopify, Beam Therapeutics. So all these companies are quite down, or huge sell-off from their all-time highs last year. So, and nonetheless, I just saw an article from Bloomberg saying that investors haven't given up. Regardless of the ARC Innovations performance, they still drew in $700 million in inflows on their ETF. So investors are still piling in on Kathy Wood's ARC Innovations.
Yeah, I'm surprised because it charges like 0.75%. So I used to hold it, but I recently liquidated ARK Invest, but I reinvested some of it in some of its technology stocks. So, well, good luck to those that are holding ARK investment. These are like, high risk, high innovation companies that are still high, potential for growth, but you're taking in a lot of risk. You just have to know the market potential if you're gonna be an ARK investor. And like I said, I was, but I decided to just go ahead and break it down into individual stocks that I have studied before I reinvest.
Because some of these companies in that portfolio doesn't even have any profit at all, so that makes them a lot of risky investment.
Risk.
Because you don't know when they're gonna belly up, if the time's up and they cannot issue debt or issue more shares to fund their operations. So this is a Fedwatch tool from CME screenshot. 99.6% of the people that it has surveyed says or thinks that the Fed would raise the Fed rate hike by 75 to 100 basis points on their May 4 meeting. So that's coming up soon.
I hope no one is going to be super surprised and run away. But if that does happen, I'm pretty sure there's going to be a lot of fear over the market. But I won't be surprised. For me personally, I won't be surprised if they do that. But again, I'm still, kind of thinking there's still a lot of new investors out there that have never experienced a recession. So it might be a different sentiment for them.
Right. Well, the COVID lockdown recession that we experienced was a blip. So it just took a couple of weeks, and then the Fed came in to the rescue, and they said that they're going to buy bonds, the mortgage. They even suggested that they're going to start buying some junk bonds and corporate bonds to at least mitigate the outflow and provide funding to struggling companies. And that kind of marked the bottom back then. But at this time, we're in a different ball field because the Fed is just starting to hike their rates. Actually, they just started by 25 basis point increase, And Jerome Powell, the chairman, Federal Reserve, said that
Mhm.
he's open to possibly 50 basis points. So 75 to 100, that's what the Wall Street experts are now anticipating in this Fed meeting next week.
And,
So
and
it's
probably pricing in already.
yep, that's actually what I'm thinking too. Maybe the bearish sentiment among the investors are, and also the Wall Street experts are now taking into account a possible of more Fed rate hike. So at this point, I think we need more guidance from Jerome Powell moving forward from the Federal Reserve. That way, they can telegraph the soft landing that they've been saying accordingly. Because if not, it's going to be a little bit tricky moving forward.
Well,
Um,
just have a cushion,
mhm. Always have
save
a
your
cushion.
dry powder for emergency.
Right. So meanwhile, as we briefly mentioned earlier, consumer sentiment rises for the first time this year, interestingly. According to the University of Michigan sentiment, we're up 65.2 points from 59.4% this April. So we're up by 9.8% from last month, but we're still down quite a huge amount, down 26% from last year. So people, or at least US consumers, are feeling the heat, inflation, and stagnant wages, I would say, because you never feel the increase if everything else around you are also increasing even more. Next screenshot, we have Exxon triples
Ooh,
buybacks, and Chevron posts best profits since 2012. So it's the past decade, past 10 years, both companies have posted best profits since 2012 for the past 10 years. Amazing. US super majors receive windfall from soaring oil and gas prices as pressure to increase drilling mounts. So we kind of have both of the companies' information also pulled up. Interestingly, Exxon actually reported that they're gonna have a 4 billion loss with their investment in Russia, but still they're
mhm.
up there. They registered a profit. So first, we're gonna take a look at Exxon's numbers quickly. So Exxon is down. Even Exxon didn't survive the onslaught today. It's down 2.24% at $85 a share. If
Mhm.
you're gonna look at its 1 year average, it's still close to its 1 year highs. It was as low as $52 a share at one point. Forward
Mhm.
earnings, believe it or not, it's still very cheap at this point in time. 9.3 times earnings for next year. Its dividend yield is 4%. Its market capitalization is $347 billion. So its performance, obviously, they miss in their earnings, probably because of the Russia investment write-off, but they did beat sales. So they missed by 16 cents in their earnings, but they loftily beat revenue estimates. Earnings excluding identified items were $8.8 billion. Okay, so they took off 3.4 billion in their Russia investment operation. So with that, we're gonna just take a look at closer what we usually would like to see in company filings, therefore giving us a better picture how they performed. Okay, here we go. So revenue for this quarter that ended in March, they registered 90.5 billion in sales, almost double the amount that they generated last year, where their profit is at, let's see, net income. Here we go. Profit is at $5.48 billion compared to
It is double.
doubled, yeah, compared to 2.73 billion last year. That's pretty nice. And their cash is at $11 billion, while their debt, it's at 42 plus 4.8, so about 543, about $49 billion in debt. So there's still leverage in this point in time. So nonetheless, they've
Mhm.
returned a good amount. profitability to their shareholders. Meanwhile, Chevron, so Chevron is down 3% at $156 a share, same as Exxon. It's trading on its above mid-range compared to past year. It was trading at one point at $92 a share. Now it's at 156. Forward to earnings ratio, price to earnings is at 10.4 times, a little more expensive than Exxon. Dividend is 3.51%. Their market cap is $307 billion. So Exxon is a little bit more valued at this point in time, at $347 billion. So Chevron actually miss their earnings as well. They also miss their revenue estimates. That's interesting. So maybe that explains why they're down quite a bit.
Is that another Russia effect? Russia war effect?
It doesn't
Probably.
show. Yeah, here in Seeking Alpha, they didn't quote the CEO or the companies blaming Russia for their underperformance in their profits. Taking a deep dive here in their earnings release. Chevron is doing part. Let's see. Maybe. Yeah, they didn't specifically mention Russia hurting their operations.
Okay.
Interestingly, so we're gonna go deep dive into their revenue. So for the quarter that ended in March, they registered $54.37 billion in sales, nearly $22 billion more compared to last year. Their profit more than double. This is like 6 times, 600% increase, $6.26 billion compared to $1.38 billion last year. Compared to Exxon, let's see. We just had it. Exxon. Let's see, where is it?
And they did well too after hours. They gained half a percent after hours trading today.
Yeah. So Exxon is 5.48 billion. Chevron is $6.26 billion. So Chevron is more profitable at this point in time, looks like.
What are they doing different? Let's see.
Probably they're, let's see, downstream, upstream. Upstream is for their drilling. Downstream is when they refine and sell their products. So they actually lost money in downstream.
So more of their upstream.
Yeah, they earn more in their upstream. If you're gonna take a look at Exxon, hopefully they broke it down, but okay. Upstream for Exxon, they earned at least 4.48 billion in upstream. Meanwhile, in downstream, they also earned some money, 332 million worldwide. So it's not clear, but looks like Chevron knows how to be more profitable at this point of time. So the company has about 11.67 billion in cash, with $29 billion in debt. So both of the companies are quite leveraged, but with high oil prices, I believe they have a long way to go. So another screenshot here, moving on. Amazon, biggest drop since 2006. So biggest losers. We just made history again this year. So Meta Platforms registered the biggest loss ever in February when it lost $251 billion in its stock price, or in its valuation, when its stock price tanked when it released its earnings report back in February. Amazon now today just made it to history. It lost $206 billion in one day because it dropped 14%. Nearly one Elon Musk there. Elon Musk is $260 billion. About 3/4 of Elon Musk. Elon Musk is still, the leader, I guess, in terms of market cap estimates. Apple, well, these are like more than a year older. So we are making history right now. We are seeing big drops in FANG stocks. So these are the market favorites. If you have a 401k, if you have a retirement account, you're actually exposed to this. And look at this next screenshot here from Bloomberg. Popular retirement funds are getting hammered as tech stocks plunge. So largest 401ks are down 10% or more this year. So people are hurting everywhere, regardless if you're a stock investor, you want to pick your own stock, or you just leave it, put it in an investment fund, 401k, put it in Kathy Wood's ARK Investments, regardless, more or less you're feeling the pain. So T. Rowe Price blue chip is down. Wow, it's in a bear market. Vanguard, this is the one that I usually would recommend, the VTSMI, Vanguard Total International Stock. No, that's not the one. The one I recommend, VTSMI, that's the Total Stock Market Index Fund, VTSMI. But this one, Vanguard Total International Stock, is down 11%. The target fund, the one that would be retiring, usually they select this target fund at the specific year, saying that at that year maybe they'll be start pulling out investments. Target 2030 is down 10%. Fidelity 500 is down nearly 10%. Vanguard Total Bond is down 9.7%. So everybody else, it's down so far this year. So quite a painful retreat from last year's record-setting all-time highs, right, Wawi?
Yeah, it just reminds me of 2008 when the market went down. But like most recessions, hopefully this one will be the same. Hopefully it won't last more than a year.
Right.
So but we'll probably see more this trajectory by the second quarter if it's gonna last more than a year. But being optimistic right now, I'm thinking it's probably gonna get better at the end of the year, like some analysts are saying.
Yep. Well, we're gonna briefly, before we go into our quote of the week, courtesy of Huawei, we're just gonna briefly look into Facebook and Google since we haven't looked in their numbers. So Facebook just released their earnings as well. Currently, it's down 2.56% today at $200 a share. If you're gonna look at its 1-year range, it actually skyrocketed yesterday from $169, its low, to $200 a share, but it's still trading at its low end range for the year. It was trading at as high as $384 a share. Forward earnings is 17 times earnings, so still a little pricey compared to the oil companies, but this is in a different industry. And besides that, Facebook is a very profitable, well, I would say at this point in time, profitable and cash rich company. Its market capitalization is $491 billion. So if we're going to take a look at its earnings report, it actually beat Wall Street estimates. According to this article, Wall Street breathes sigh of relief as Facebook reported its earnings. So if we're going to take a look at its earnings report, which we prefer to look at aside from the quotes and quotations. So for the quarter that ended in March, Facebook generated $27.9 billion in sales, $1.8 billion more compared to last year. Mind you, this is a slower growth. I think this is the slowest growth that they have registered according to some of the reports. Their profit actually drops from 9.5 billion last year down to 7.5 billion. So it's about 2 billion drop in profit. Still a little bit profitable compared to the oil companies for sure. Their cash is at 14.9 billion plus 29 billion. So 29 plus 14.8. That's nearly $44 billion in cash. While I don't see any debt at this point of time. So Facebook remains to be cash rich, no debt at all. $44 billion in cash. So we're
and
gonna. Uh-huh.
and his shorts have just expired this week. So I'm bullish by next week for Facebook to go up. You
Uh-huh.
know,
Well,
so you're
hopefully, so they change that trend. Hopefully, um, at least at the meantime, right? Short term
Mhm.
wise,
Short term wise expected to go up, but that's just me. Just looking at the shorts, it's at negative 2.5 million today, and it had a slight uptick after
yeah,
market.
yes. Hopefully, so we'll carry on. But hope is not it's not a good a good investment
Well,
conviction, I would say. But
exactly. Well,
companies cash
it,
rich.
it is cash rich, plus its PE ratio is below the 20 that's in the industry standard.
Right.
So it's 14 and a half right now.
Mhm.
Um, I think it's just being pulled by current sentiment for sure. Um, are they losing subscribers?
I think they
Uh,
generated more at
okay,
this
good.
point. The daily users have met an
Because
increase of 6% compared to last year.
yeah, and if they can tap into Asia, that's the problem, right? Google experienced that in China. They can't get into China because China
Mhm.
is like close to this type of uh, social media giants. But if they can tap into certain areas in Asia, just like I know in Southeast Asia, Facebook is being utilized. Philippines, I don't know
Right.
about Vietnam, but um, in Borneo, Brunei, Indonesia, I'm pretty sure that they're using it.
Mhm.
Um, Australia for sure, right?
Right.
So there's still a huge untapped user base there.
Mhm.
And I think this pivot to Meta, this pivot to the metaverse that you can call it,
Mhm.
some people still don't know it, but I think it's a good pivot.
Yeah, it's quite interesting because that labs actually gave them nearly 3 billion in losses as of
Mhm.
the last 3 months. Actually, they kind of this kind of amount of loss actually beat estimates because they're expecting more losses. That's why
Mhm.
their shares kind of rallied as well. So we'll see how
Remember,
it goes. Mhm.
I know, but remember, this is the company that came up with the first, cryptocurrency, in social media.
Yeah,
It is
Libra.
just, yeah, it's just, if you look at this company's ambitions, it's just way ahead of, the current um, socioeconomic, um, what do you call this, adoption.
Right. Well, we'll
And,
see how Zuckerberg's manifest this
well,
kind.
it had a lot of negative vibes,
Mhm.
last year for sure, but it still got a good stronghold. You know, it's got a captured market already, and if they can keep that user base, you have a tremendous opportunity.
Right. Well, we're gonna jump on to the last company that we're gonna take a look at, Google, or also known as Alphabet. It's down as its shares are down 3.7% today, trading at $2,282 a share. If we're gonna look at its 1 year range, it's actually close to its lowest at this point in time. Its price to earnings ratio forward is 21 times earnings. It's currently valued at $1.57 trillion. So Google actually missed also a lot of misses for big tech. It missed Wall Street earnings estimate, but it did beat Wall Street estimate of revenue by 140 million. So if we're going to take a closer look into its filings, its revenue, it's up $68 billion from 55.3 billion last year. It's up 23%. Its profit, wow, believe it or not, is down $16.4 billion from 17.9 billion last year. So that's the miss right there. Google search, still a money maker for this company. Revenue is up nearly $8 billion. YouTube is up $800 million. A little bit slow there, I might say. Google Cloud, it's up 1.8 billion in sales. Services. Sorry. Services includes the Google search and stuff. So we're not going to take a closer look at that. Total TAC. This is their critical number for traffic acquisition costs, or how much it cost them. I think at least 10 billion from this is already a year is allocated to Apple. That's why they're the default Google search engine when you pull up a Safari browser. So total TAC, it's nearly $12 billion from 9.7 billion. So their cost has everly been increasing, and they're hiring more employees, looks like. So let's look
Well,
at
it's
their cash
one of those
situation.
companies that are not, highly volatile.
Mhm.
So I think it's 50% below its fair market value right now.
Mhm.
So,
Yep. So its cash standing at this point in time as of March is 133.97 billion, almost 134 billion. It's down nearly 6 billion from last year, from 139.6 billion. And I don't think they have debt. If they have that, must be just not negligible. It's 14.7 billion in debt. So they can easily pay this off, but I wonder why they keep it hanging out there. So yep, they did experience a drop in their profits. Let's see any quotations from we are pleased. So I guess they're still pleased with their performance. So it says here on April 20, the board of directors of Alphabet or Google authorized an additional $70 billion in buybacks. So they're joining Apple in their buybacks at least.
nice. That's good for shareholders.
So they're clearly trying to settle or provide a support for their stock price. So it's quite interesting. Their performance is a little weak on the profit side. But nonetheless, I think it's a good company regardless. They'll survive regardless what happens to the overall stock market, regardless if the interest rate hike continues or not.
Well, a good portion probably comes from ad revenue, right? Don't you think so, Mark?
Yep, I agree with that. Mostly it came from Google services and ad revenue.
Mhm. That's what Netflix is trying to do now.
Yep, they're trying to at least catch some of those sales that they're missing from the ad side. Well, Wari, do you have any quote for the week for our listeners?
Yeah, this is from IBKR, from one of their people. So this is looking at intangible assets. So this is worthy. Just bear with me. As the market value of equities increasingly skews towards intangible assets, alpha generation necessitates identifying the data sets and indicators that can capture the move amorphous drivers of value, where accounting standards and traditional fundamental analysis have failed to keep up. Quantitative methods can unlock the opportunities. So that's what you're saying, Mark. It's not just hope. You just have to look at the data set.
Yep. Build their conviction, and hopefully it plays out on the long term, which typically does, but there's no telling the range of recession or the downfall. It can be just ended up in a couple of weeks, like what happened in COVID lockdown, or it could be years, like 2007, 2008 recession. Housing market actually further went down the drain back in 2011, so it doesn't happen all at once. So we'll see. Well, Wari, thank you so much for coming on this episode.
Thank you so much, Mark.
And listeners, that does it for this episode of Mark Q and Wari Show. Please continue your support. Hit the like button, share to other, possible investors out there that are trying to look their way through this ongoing turbulent market. Send us an email if you have any question about a specific stock at markyowawishow@gmail.com. And remember, build up emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And Wawi Santos, don't forget to subscribe.
Bye.